So, India's got this huge, ambitious goal to become a fully developed economy by the year 2047. But how does a country with over a billion people actually make a leap that big? Well, the answer might not be what you expect. You see the year 2047 everywhere now. And yes, it marks 100 years of India's independence, but it's become so much more than just a date on the calendar. It's now the North Star for the country's entire economic plan, a hard deadline for a truly massive transformation. And look, the ambition here it's off the charts. We're talking about a multi-trillion-dollar jump. So naturally, the first question that pops into everyone's head is pretty obvious. How on earth do you finance a dream this big?
But hold on. What if that's not quite the right question to be asking? What if the whole debate about funding this growth story is missing a much more important, much more fundamental point?
Okay, so here's the big shift in thinking we're talking about. The challenge isn't just about the quantity of capital, how many billions or trillions can be raised. The real game changer is the quality of that capital. Is it stable? Is it being used efficiently? Because you just can't build a modern developed economy on a shaky or wasteful financial foundation. It won't last. All right, so how do you actually build that high-quality system? Well, it really comes down to four critical pillars. And the first one is all about getting back to basics, rebuilding the very foundation of the economy, which is domestic savings. Now, economists have a term for this. They call it the binding constraint. And you know why? Because everything else depends on it. Foreign money can come and go, and government spending has its limits, so the most reliable, long-term engine for growth has to come from within. It has to come from a country's own people saving their money. But here's the catch, and it's a big one. Net household financial savings, which is the biggest chunk of that domestic pool, have actually dropped to just 5.3% of GDP. That's a multi-decade low. The foundation is looking a little shaky. And get this, at the exact same time that savings are shrinking, household debt has been climbing fast. It's now over 40%. It's like being squeezed from both sides. Less money is being put away for the future, and more is being borrowed for today. So you gotta ask, where is all this borrowed money going? Well, it's mostly going into day-to-day consumption and housing. And look, that's obviously important for families, but it's not the kind of spending that creates long-term productive assets for the country, like brand new factories or critical infrastructure. Okay, so if domestic savings are the fuel for this economic journey, what's the engine that's going to use it? That brings us right to our second pillar, making a big shift in where the long-term money comes from. Think about it like this. Banks are fantastic for certain things. They take our short-term deposits and give out short-term loans. Perfect for a business that needs working capital. But the 2047 vision, that requires huge long-term investments, things that might not pay off for 20 or 30 years. That creates a major mismatch. And that's a gap that only deep, healthy financial markets can really fill. And if you look at a key part of the market, say India's corporate bond market, you can see the challenge. It's still pretty small compared to the size of the economy, and it's dominated by just a few really big, top-rated companies. Plus, it's not that easy for regular people, for retail investors, to get involved. All right, on to pillar number 3. And this one is really interesting because it isn't about finding more money. It's all about using the money we already have way more effectively. It's all about capital efficiency. Okay, let's just quickly break down a piece of economic jargon, but it's super important. It's called I-Core. All it means is, how much money do you have to invest to get one extra unit of economic growth? In India, that number's around 4 to 5.5. Basically, the lower that number, the better. It means you're being way more efficient with your capital. And that's why this isn't just some nice to have. Improving capital efficiency is a first-order growth strategy. Getting more out of what you already have is just as powerful, maybe even more powerful, than raising billions in new funding. It's about working smarter. So how do you actually do that? Well, it's not some abstract theory. It comes down to very practical things, the nuts and bolts of how the economy works. We're talking about faster approvals for projects, contracts that are crystal clear, regulations you can count on, and a system that resolves disputes quickly. And that leads us to our fourth and final pillar. This one's a potential game changer, a real force multiplier that can bend the entire growth curve. Technology, and specifically India's thriving startup ecosystem. It's so easy to underestimate the role of startups in the grand scheme of things. We tend to think of them as just creating cool apps or new services, right? But their real power is at the macroeconomic level. It's a hugely important but often underappreciated tool for growth. And the real magic here happens with the deep tech companies. These are the startups that are driving massive efficiency gains in the core sectors of the economy: logistics, manufacturing, healthcare, you name it. They're finding ways to produce more value with less capital, and that raises productivity for everyone. Okay, so let's zoom out and put all four of these pieces together. How does this all connect to create one single powerful strategy to hit that 2047 goal? It really comes down to this simple but powerful logic. First, you rebuild the foundation by encouraging domestic savings. Then, you build deeper markets to act as channels for that money to fund long-term growth. At the same time, you boost efficiency so every single rupee works harder. And finally, you use technology and startups to turbocharge the whole system. You see, each pillar reinforces the others. So there you have it. The blueprint is on the table. The conversation has clearly shifted from just how much money can we get to how can we build a better, more efficient system. The path forward is pretty well mapped out. So the defining question isn't what should we do anymore. The real multi-trillion-dollar question is one of execution. It's all about getting it done.